Preparing for the future starts with a choice. Choose growth with My Choice Investment. Discover investments suited for your aspirations. Invest within your budget and get started easily for as low as 1,000 pesos. Enjoy convenience with professional fund managers and an auto invest feature. Access investments anytime, anywhere with Metrobank Online. With diversified products that suit your risk profile and investment horizon. Tap into local and global markets using Philippine peso and US dollar funds. Invest today, be empowered tomorrow with My Choice Investment. Visit your Metrobank branch now or add to your portfolio via Metrobank Online.
Hello, good morning, everyone, and welcome to today's exclusive webinar entitled Diversify Across the Globe with the Metrodollar World Equity Feeder Fund. I am Gina Guevara, and I will be your host and moderator for today's festivities. Just a quick reminder, before we begin, we encourage everyone who will have questions later to just type in your questions as we go along, even with the presentation even while the presentation is ongoing. So we may try to squeeze them all in our Q&A portion later today. Now to begin, we have Metrobank First Vice President and Head of Trust Investment Management Division, John Padilla, to formally welcome everyone. John?
Good morning. Thank you for that, Gino. And good morning, everyone. Good morning, friends, for joining us in this webinar this morning. We're very excited because it's another milestone for our fund. For those of you who've been with us since the start of this fund, the Metrodollar Equity Feeder Fund, you would have seen your investment grow by a little bit, just a little over 80% already in dollar terms. But if you convert that back into pesos, you can add maybe like a 5% more for that. But while your investment was growing over the last 5 years or so, we at Metrobank have been hard at work to make sure that we continue to deliver the kind of product that you deserve. Over the last several years, we've strengthened our research capabilities. The team is now headed by Don Hernandez. You've probably seen him in previous webinars. They are the reason that we are able to share with you the new development in this fund as we have strengthened our fund selection framework capabilities. Next, we've made sure also that your journey with us is not just financially rewarding, but we want to make sure that it's also easy and convenient for you. So the team of Sharon Zulueta has been making that possible, making sure that you are in the right product and making sure that you have all the information and it's easy to invest for you. But in all of that, our group head, Mr. Donny Santillan, has been guiding the ship towards making sure that Metrobank will be at the top of everyone else in terms of offering you the best product out there. So let me not hold you any further. Today, we're very grateful that you can join us as we mark another milestone in the Metro Equity Feeder Fund by welcoming our new partners. I believe this will be the first of a series of engagements with them as we journey maybe through the ups and downs of the market. As I said, it won't always be a straight line going up. For those of you who probably observed the behavior of the fund last year, you would have probably seen a red figure in your ROI. But today, we are at the highest of our NAVPU. So all of you, I believe, are already in the money. So as I was saying, we want to make this as convenient and as easy for you. For just a little over $500, you can start investing already, topping up for $100, just as low as $100. Just making sure that you're here with us for the long term. Maybe our new partners will articulate that further, the benefit of being in the fund, not just for the short term, but for the medium to long term. So I guess that's it for me. I really thank you. I hope you can join us for the next few minutes or maybe 1 hour, and I'll see you in the question and answer. Thank you.
Thank you, John. As your trust partner, we know how important it is now, maybe more than ever, to be well informed and constantly remain updated on the changes and different strategies to know how we can achieve greater potential for the investments we offer. Go global and make your US dollars work with you with My Choice Investment. We would like to encourage everyone to take advantage of this opportunity to learn from the best of what this industry can offer. We have thus invited two key investment experts from Artisan Partners to discuss more on the new Metrodollar World Equity Feeder Target Fund, Artisan Global Opportunities Fund, and their respective outlook in the global markets. So without further ado, allow me to introduce to you our speakers for today. Chip Ridley is a managing director of Artisan Partners and the business leader for the firm's growth team. Prior to joining Artisan Partners in June 2006, he was a director of business development and consultant relations for Grantham Mayo Van Otterloo & Co., where he managed the institutional marketing efforts for Western North America and served as a product manager for the emerging market strategy. Before that, he was a corporate vice president and principal at Montgomery Asset Management. Mr. Ridley also spent 9 years as an aviator in the United States Navy, where he flew and instructed various types of fighter aircrafts. Mr. Ridley also holds a bachelor's degree in economics and history from Duke University and a master's degree in business administration from Mississippi State University. Whitney Drayton is a managing director of Artisan Partners Australia, with the primary responsibility of leading Artisan Partners distribution and business development efforts for the firm's global and emerging market strategy in Australia, New Zealand, and Asia. Prior to joining the firm, Mr. Drayton owned and operated Grapevine Advisory. Before that, Whitney was Director of Institutional Business Development with Wellington Management and an Executive Director with Morgan Stanley & Co. Mr. Drayton holds a bachelor's degree in political science from the Colorado College and is a graduate of the Australian Institute of Company Directors. Please let us all welcome on stage Managing Director and Growth Team Business Leader, Chip Ridley, and Managing Director and APAC Head of Distribution, Whitney Drayton. Yeah.
Thank you very much for that introduction. This is Whitney Drayton speaking to you from Sydney. We're very, very pleased to be partnering with Metrobank with our growth team. And today, I'm just going to walk you through a couple of quick slides that describe our company. And then I'm going to hand things over to my colleague Chip to tell you more about the portfolio. What I might do is just move to the next page. And there we go. If everybody can see this page. Artisan Partners was founded 25 years ago by a husband and wife team, Andy and Carlene Ziegler. And they had a vision that active management, which is what Artisan does, where we actively select stocks through fundamental analysis. They felt that active management really was in need of improvement, and they were very focused around investment talent acquisition, locating and identifying the best portfolio managers they could, and putting them into an open architecture framework where they could operate in their own office as though they own their own business, but have the support of a business that allowed them to operate on a distraction-free basis. So from very humble beginnings in 1994, Artisan started with our growth team, which is what we're talking about today. And if you look at the lower left circle, you'll see the brown, solid brown area. That's our growth team. They're based in the Midwestern United States, just north of Chicago in a lovely city called Milwaukee. Sits right over Lake Michigan. And this team has evolved over the last 25 years and has grown enormously in time through their very, very strong returns. From humble beginnings, the firm has had purely organic growth in its business. We haven't bought other firms. We're not an acquisition type of firm. We just develop things from the ground up. And today we have 9 very distinct teams, 8 of which are focused around buying and selling shares on an active basis. We have 1 team that's a fixed income team. Most of our business, if you look at the lower right circle, the light green and the dark, is purely institutional. So we're not really a retail type of firm. We want to partner with class operators like Metrobank, who can touch base with all of you on a personal level, Artisan is very focused around its investments. And I'll take you through the types of strategies we have. On this next slide, in our business model, you'll see our different teams. They all have different style factors to them. Some are more growthy oriented. Some are more value, looking for less expensive stocks to buy. Some are more geographically focused around the United States. Others are global in nature. And today they create a mosaic of a number of top performing equity portfolios, but all supported by what is centralized, which is our business units. If you look at our business units, areas like marketing, legal, IT, real estate, compliance, finance, operations, those things are all centralized in our head office. But our investment teams all operate independently and autonomously and have their own decision making independent of each other. And we think that this decentralized investment structure really works to the advantage of our investment teams to have the operational leverage from day one when they begin and have best-in-class business support as they evolve over time. The last slide I'm going to take you through, it looks a bit complicated, but it's really just a timeline going back 25 years left to right. And on this page, you can see we have various teams down the left-hand side. The growth team, which Chip will talk about today, is based in Milwaukee. It's actually our only investment team that is based in the head office. All the rest of our teams are in different locations. They started 25 years ago with U.S. domestic growth strategies in the smaller and mid-cap space, which is really where they've evolved over time. Their expertise is in identifying smaller companies, not tiny companies, companies sort of 10 to 15 billion, maybe a bit more in value, and then seeing them grow, compound over time. As they've evolved and as the team has grown and expanded, they launched into global opportunities, which is a large cap or larger cap global concentrated portfolio. It's really a portfolio where we take the best 40 or 50 ideas from around the world and put them into one fairly concentrated portfolio. And we do that to get the maximum impact and have the best in class companies, all with the support of the investment team. So just to review Artisan Partners, today we have approximately 175 billion in assets, which seems like a lot, and it's extraordinary that we've grown from virtually nothing in 25 years. We're focused around active equity management and encouraging our investment talent to operate on a distraction-free basis, and we've been very thoughtful about the growth of our business. So with that, I'm going to hand things over to Chip to introduce you to the growth team, and in particular, our global opportunities portfolio. So I'll sign off from here and happy to take questions later. Thank you very much.
Perfect. So I think I have control now, and I seem to. So I'll say also thank you very much for taking the time to listen to our presentation today. It's a pleasure to tell you a little bit about what we do at Artisan and how we try to beat the markets in the Artisan growth team through the global opportunity strategy. I'm going to use the usual format of telling you the people, the philosophy, the process, and the positioning of the strategy. And I look forward to some questions at the end. I'll try to pace myself to do all this in around 20 minutes or so, which means I'll be relatively brief, but hopefully I'll throw enough examples in there to make it colorful. And then I'll hopefully be able to bring some of it together if there are some questions that get into some details beyond what I cover. So I'll start, as I mentioned, by introducing my colleagues who are responsible for Artisan's growth team. We are under the leadership of a gentleman named James Hamill, who goes by Jim. He's a close friend of mine, and Jim has been with the team since the founding of the Artisan growth team back in 1997. So he's been at Artisan Partners for 24 years and has been instrumental in hiring everyone you see on this page and really being the architect of what we do within the Artisan growth team. Jim's background was as an analyst first, covering consumer and manufacturing companies. He had worked at the Kimberly-Clark Corporation, doing everything from financial roles to actually negotiating with Kimberly-Clark's labor force in the re-equipping of a factory to actually operating a diaper machine at one point very early in his career. So he understands business from a practitioner's level. And if you get the opportunity to look through the biographies of many of our investment team members, you'll see that they share Jim's background and that they worked in their particular field before coming to investing. We think that's very important because at the end of the day, we're trying to invest in businesses, not just a series of financial statements. And it helps very much to have good context for what those businesses actually do. A good example of that among our senior analysts is Ashish Rao, whose name is right below Jim's. Ashish is an associate portfolio manager who's responsible for technology. Ashish worked for many years at Intel Corporation before getting into the investment side of the business. He's been a software designer, a project manager, and understands technology at a level that only someone who's really worked around highly sophisticated technology solutions in hardware and software understands it. That background has proven to be wonderful for his ability to pick stocks at the right time and add value for our clients. As you go through the biographies of the other members of our team, you'll see very similar backgrounds related to the industries that they cover for us. So we're a team of 20 investors, plus myself overseeing the business development client service team, all based in Milwaukee, Wisconsin. If you're not quite familiar with where Milwaukee is on a map, it's about an hour north of Chicago, which is the third largest city in the United States. We use Chicago's airport when we get on airplanes to fly around the world. But Milwaukee's proven to be a very good place for us to build a business that's a little bit away from some of the distractions that come in the major financial hubs in the United States. Given our size and our reputation, plenty of companies come through Milwaukee to see us when they're looking to raise capital. And we find it very, very easy to go see them when we want to do the same in reverse. But I'm very, very proud to represent the Artisan Growth Team. This consistent group of individuals is responsible for the track records that you see that we've been able to create, particularly for the Global Opportunity Strategy. So how do we do what we do? Really, this page describes it all in a basic way on the right-hand side of the page. We think stock prices follow profits. And it's been our experience that when companies see their profits increase, then investors will reward that company's stock and the price will go up. It's sometimes a little easier to say that than to actually find companies where you can identify a profit cycle in advance, but that's the goal of our team every day. And having a group of subject matter experts who've spent their entire careers focused on a particular industry helps in that regard. But we're looking for companies where we think profits will accelerate and that we can be involved in those companies over a long holding period and enjoy that profit cycle. Everything else on this page simply says we want to develop a stock selection methodology that helps us to be right more often than we're wrong, although mistakes are inevitable in any kind of investing. And we want to be right in a bigger way than when we're wrong. And I'll come back to each of these important points on the next 2 pages, along with some examples. So when I talk about security selection, I'll just begin at the bottom of this page, simply because I've already referred to the idea that what we're looking for in identifying interesting companies are companies where we believe profits are going to accelerate in front of us. And we can enjoy a nice business cycle to invest in behind a great management team. That's how we really think about playing offense and getting great gains for our investors. So what can lead to an interesting profit cycle opportunity? It could be a new product. It could be a new service. It could be a change in a management team from a group that wasn't necessarily getting the most value out of a company to a group we've seen do great work somewhere else. It could be a merger or an acquisition or a divestiture. Or it might even be a change in government regulation that just drives the market to a company that's got great market share in a particular place. I can give you examples of all those different kinds of catalysts as you look at our portfolio. And that's how we play offense, because what experience has shown us is that when we get that right and we're able to predict a profit cycle early, then we'll tend to make money for our clients. But it's not worth taking the risk on an uncertain profit cycle with just any company. And what these next 2 blocks above attempt to do is explain some of the quality characteristics we're looking for that help give us a bias toward getting it right more often than being wrong. We talk about franchise companies, and franchise can mean different things to different people. It's a word that we use that really represents quality. Said another way, it's the competitive moat that a company has around its business that makes it difficult for their competitors to get in their way. And what we found is that in different kinds of industries, that means different things. In real estate, that's having the best location. In manufacturing, that's being the low-cost producer or the high-quality producer. In healthcare or technology, that's having patent protection around your product makes it difficult for your competitors to duplicate your opportunity for success. Any of those things can be a sign of quality that can help us get comfortable that a company with an opportunity to grow its profits will be able to actually prevent its competition from taking that away. But it's important to have some guardrails. Let me give you an example. We've probably made more money investing in healthcare stocks for our clients than any other sector in the portfolio. In fact, the biggest stock we've ever owned in this portfolio is a company called Regeneron that had a blockbuster drug for treating macular degeneration or black spots in people's vision as they age. Regeneron's Eylea product absolutely turned the market over, and we were there early. That was a great opportunity for us, but Eylea wasn't Regeneron's first drug, and it wasn't their only drug that they had an opportunity to do well with. In spite of the fact that we love the growth potential from biotech drug development companies, we would never own a single drug, pre-profits, still in trials, biotech company. They can be great investments if you get that right, but drug development is not a risk-free enterprise. And if a single drug company has to announce that that drug has hit a snag going through its trials, you'd lose 80% of your investment before you'd have a chance to start trimming that position. What we want instead is a little bit more mature company that's shown they can take a drug all the way through the trials process, that they can get it approved, that doctors will switch their previous standard of care to that new drug, and crucially in the United States, that they price it in a way that insurance companies will reimburse for. And then further, that they've got a research and development platform behind that will give them more shots on goal or interesting drugs that go through time. What it means is that we look for drug companies that are a little more mature. But what we found over time, we didn't invest in Regeneron until it was a $3 billion market cap company. We didn't add it to the global opportunities portfolio until it was a $5 billion market cap company. That stock peaked at $50 billion in market cap. So waiting until it was $5 billion in market cap and already had a proven winner on its hand didn't keep us from making 10 times our money for our clients. And that's the kind of quality foundation we look for in really every company we would invest in. And we call that franchise characteristic. It's also important to pay attention to how much you have to pay to own a company. We're investing in high quality companies with great growth potential. They don't usually trade cheap relative to the market. But over 25 years, we've developed a valuation methodology that has proven to give us a really dependable margin of safety when investing in high growth businesses. We call it discount to private market value. And to keep it very simple, we just think about what this company can do in growing its free cash flow over the next 3 years and how much that cash flow is worth to us today if we put in some reasonable considerations in the risk that we have to take to wait for that company to grow that cash flow. That helps us determine a price we think the company might be worth if we wanted to buy it in its entirety, in the way a private equity investor might think about it. But since we're not going to buy the company, we're not going to offer to buy the company, so we won't be a majority shareholder, we won't get board seats, we won't get to see the books. We want a big discount to that. And what we want, generally speaking, is a 25% discount to what we call the private market value. So when we find a company that has an interesting profit cycle opportunity or catalyst in front of it, that has all the quality characteristics that we think will protect that opportunity, and it trades at a reasonable margin of safety, then that can be a very interesting company for us. And those are the kinds of businesses we want to own. The interesting thing is that can lead us to a portfolio that's got everything from some of the world's largest businesses like Microsoft or Volkswagen in the automobile space to some companies you've probably never heard of, even though they dominate their space. I'll talk about a company in a few minutes called Lonza that is probably not a company you've ever heard of, but they are the world's largest third-party distributor of biotech drugs. Because increasingly, biotech drugs come out of research labs at universities. Very smart doctors and researchers come up with great recipes that have phenomenal abilities to change the therapy for patients and improve their lives. But they're not big companies, and so they turn to Lonza and say, here's the recipe. Lonza manufactures it, packages it, sends it off to the regulators who review that product, and then ultimately, if the product is successful, then they'll be the ones to distribute it around the world. Lonza, you may not have heard of them. You've probably heard, though, of Moderna, because it's one of the most popular and effective COVID-19 vaccines. Lonza makes every single vial of Moderna vaccine that's sold around the world. That's the kind of business they have. It's maybe a little bit below the radar screen. It's a wonderful growth business. Very hard to get into because it takes significant manufacturing capacity to do what they do and a reputation for quality. So it meets our franchise characteristics, and it's a good example of the kind of company we want to own for you. Now, when talking about capital allocation, what I'm really talking about is how big a position would we take in any one of these companies in which we might invest. At the start of a campaign, we like to call that the garden. That's when we take a small position because we're trying to be early. We think there's a good opportunity for profits acceleration, but we just don't know. And the laws of competition and capitalism can get in the way anytime. About a third of the time, something gets in the way of a profits thesis. The new product doesn't sell. The merger that you were invested behind gets blocked. A new management team's turnaround plan just isn't successful. And we'll find that it's time to move on after 2 or 3 quarters of not seeing it work. The way we protect you in taking that early stage risk is to have a very small position of something under 1%. We call that the garden, and that's where we get most of the turnover in the portfolio. Once a name becomes a high conviction position, though, where we see that profit cycle opportunity playing out, we call that the crop of the portfolio or the core. All of these names come because Jim Hamill grew up on a farm, and as he tried to think about articulating this process, an agricultural motif sort of worked for him. But in the crop, we're talking about the top 20 largest positions in the portfolio. It's going to be 60 to 70% of all the capital that we manage for you. And it's going to be low turnover and where we get the vast majority of our value added in our winners. Because once a name has that profit cycle working for it, the franchise characteristics are intact and the valuation is reasonable, what we found is that most of the time those businesses work really well for us. And then we talk about the harvest, which is simply the way we think about selling stocks. We see that profit cycle start to mature and come to an end. Perhaps the stock gets too expensive and there's no real discount to give us a margin of safety, and it's time to move on. I will say, this may seem relatively straightforward. I really think this is one of the best things that we do. And it's one of the ways that we've differentiated ourselves over the years, because we haven't been afraid to own positions in companies of 5, 6, 7, even 8% of the portfolio when everything aligned behind us. And one of the points I want to make is, no matter how good a stock story you hear from anybody who talks about having picked a company that did really well, the most important thing in terms of the return that it gives them is how much did they own. If we own a stock at a 1% position and it doubles, great, we just made you another 1%. But if we own a stock at a 4% position and it doubles, now we've made you a whole lot more money. And so one of the points I want to make that I think is frequently overlooked is getting stock picks right is great, but having the conviction to get meaningful capital behind them at the right time in their cycle is even more important. And I think it's something that we've managed to do extremely well over the years. So I didn't want to leave out having a chance to talk about garden, crop, and harvest and portfolio allocation. This next page just simply shows you that over the years, in that blue line at the top, we've kept the portfolio concentrated. So you're going to get most of your exposure to our 20 best ideas from around the world. We're going to own a portfolio that in total is going to be about 45 stocks. It will be names that come from up and down the market capitalization spectrum, from small companies to large companies, everything from relatively small, very interesting, dynamic software businesses, all the way up to the Microsofts of the world. We're happy to find growth wherever it occurs and in whatever country it may occur, everything from the United States to developed markets to emerging markets. And we want to run a fully invested portfolio for you. Typically, we'll keep cash to less than 5% of this portfolio to make sure we get the most bang for the buck we can from our stock positions, because that's critical. So where's the portfolio allocated? Well, these are some top line numbers, and I don't want to spend a lot of time on them because you can read them, and I don't know how illuminating they are. We have a portfolio that in general is a bit smaller than the benchmark. So what you should expect is this is not going to simply get you exposure to what are known as the FANG stocks: Facebook, Alphabet, Apple, Netflix, Google. We've invested in probably all of those stocks over time. But right now, the only one of that group we really have is we have two of them, Microsoft and a small position in Netflix. We tend to find most of our better opportunities by looking further down into smaller names, which is what you see at the bottom of this page, where most of the capital is not in that largest group of stocks. In fact, the biggest overweight we have is in what we would like to think of as that mid-cap strategy, mid-cap area, where we have a lot of experience as a team. You can see the regional weights in the portfolio. Again, we're a bit overweight Europe. We're more or less in line with the Americas, and the Americas is about 95% the US and 5% Canada. So you can think of that as representing our exposure to the US. Where we're meaningfully underweight is in the emerging markets. And I think it's worth a comment because China is by far the biggest constituent in the emerging markets. we've been frankly concerned by a lot of the regulatory changes we've seen taking place in China over the last couple of years. And we're pretty happy that we've been mostly underexposed to China over that time. We've seen China come down pretty hard on some of their wealthiest people, like Jack Ma, who perhaps made a mistake in chastising his regulators when he wanted to take Ant Financial public, and then found that the Chinese government simply turned around and canceled the IPO. We've seen the Chinese government simply wipe out the for-profit after-school tutoring and education industry by suggesting that profits in that space were immoral and those companies should convert to not-for-profit. That wiped out $100 billion in market cap literally overnight. We've seen the Chinese government become unhappy with Didi, the Chinese version of Uber. And when Didi decided to list in the United States instead of in China, the government simply closed their website. This heavy-handed regulatory change in China makes it difficult for us to feel confident in our profit cycle thesis for many Chinese companies. We absolutely believe in the long run, China will be a great place to invest. It's the world's second largest economy. We've had big investment campaigns in China in the past, but right now we don't have any direct exposure to China, and I suspect it'll be a little while before we get any more. In talking about sectors, I think this is a place where we could spend a lot of time, but I want to be relatively brief so we can get to questions. You can see in those darker lines the sector weights that we have in the portfolio. I've already spent some time on healthcare, so you might not be surprised to see that healthcare is our largest weight in the portfolio. A lot of weight in technology as well. What you don't see is much weight in what we would call the more cyclical parts of the global economy, things that are tied to commodity prices. For us, we completely respect businesses that provide cyclical products and services to the global economy. And typically when the economies are growing rapidly, commodity-based businesses do well. But you have to feel very confident in what's going to happen to the price of an underlying commodity, like oil or steel or interest rates, to have a good sense of what's going to happen to profitability within a company. And usually the management team can't do much to control that. After all, the CEO of a large oil company can't really do much about the price of oil. The CEO of a large bank can't do much about underlying interest rates in their home country. And that takes a lot of that profitability opportunity out of management's hands and leaves it into the destiny of what the economy and markets decide to do. We like companies where management teams have most of their destiny in their own hands. And so that's why we're really attracted to things like healthcare and technology in general. In the interest of time, I'll just show you what some of the top holdings are. Some of these names will be well known to you and some of them won't be. Tektronix is a name you might not know. And interestingly, it's shown up as a non-US holding. It's domiciled in Hong Kong. But a couple of their brands are names that you probably know really well. Milwaukee Power Tools. Professional contractors love Milwaukee. Ryobi, if you're a do-it-yourselfer who's got home improvement projects, then you probably have Ryobi Power Tools. And the world is changing. They're going from tools that are plugged into the wall to tools that you can recharge with a cordless battery system. They're even starting to get outside and start to cut into the market share of small gasoline-powered engines. I know in my own home state of California, the government, starting in 2023, is outlawing small combustion engines that you'd use in lawnmowers, leaf blowers, hedge trimmers. And all of those people who own those kinds of devices are going to be stuck having to convert to some kind of electronic, most likely battery-powered device. Tektronix is in the driver's seat, and their growth has looked spectacular. Maybe not a household name, but you know their brands, and you can imagine the power of that trend working for them as the world goes to battery-powered rechargeable equipment. Again, in the interest of time, I'm not going to take you through all these names. I've already mentioned Lanza Group, and you may know some of the others. But if you don't know the other ones, then I'm really pleased, because we'd like to think we can give you exposure to a great global growth strategy where maybe not every one of those holdings is a household name. I've talked about Lanza, so I'm not going to spend more time on it. NextEra Energy, I'll simply say that it's a large power utility. They're the large power provider for the state of Florida, which is one of the fastest growing states in the United States. NextEra's tagline is, "We are the world's largest provider of wind and solar power." They're a utility that's fast moving away from fossil fuel burning, carbon emitting sources of power to wind and solar. Government loves it. The regulators love it. They're letting NextEra earn higher profits than they normally let utilities earn as an incentive to get them to convert more and more of their power generation to renewables. NextEra Energy is at the head of the curve on that, and it's turning out to be a wonderful stock for our clients. In the interest of time, I'll perhaps just conclude on this performance page. You can see that, in general, the green bars that represent our performance are a bit taller than the gray bars that represent the benchmark. We're very, very proud of the returns we've been able to deliver for our clients. In many cases, it means the difference between being able to retire securely or have that education paid for your child, whatever it is. Our ability to add value for our clients is incredibly important to us. And I will tell you that no one has more of their own money invested in this fund than Jim Hamill and the other members of our investment team. We're invested right alongside you. We've been there since day one, and we are committed to continuing to try and deliver the same kind of performance for our clients into the future. So I'll stop with my prepared remarks there. I'll be more than happy to take questions in the remaining time that we have, and I want to thank you in advance for those questions, and thank you for your attention today.
Thank you, Chip. Thank you, Whitney, for the wisdom you've shared with us in the last 20 minutes or so. Now, once again, I'd like to remind the audience to please don't hesitate to type in your questions in the Q&A portion in the coming minutes. No, but before that, I'd like to inject a small spiel on how you guys can open your own Metrodollar World Equity Feeder Fund. If you can move on to the next slide. Yeah, perfect. So for a first-time UITF clients, you'd have to open the account with your nearest, with your respective Metrobank branches. However, the beauty of this is for succeeding top-ups or even redemptions, you can easily transact online through Metrobank online app. Very easy to use. I can guarantee you that. Else, you could also contact your closest or your nearest relationship managers for further queries. Now, we'd like to call back John, Chip, and Whitney for the Q&A portion. First question, I think this will be addressed to Chip. Chip, may I know how the portfolio has probably changed over the last year or so to the height of the pandemic? How did you adjust, especially as earnings took maybe a bit of was more volatile? How were you able to adapt?
Sure. Well, you can imagine that a portfolio that was heavily exposed to healthcare and technology and very lightly exposed to cyclicals enjoyed a pretty good run through the pandemic as it shut down most travel and really put the global economy into a deep slowdown. What we found, and we don't own it anymore, but one of the larger holdings we had in the portfolio early in 2020 was Zoom. Now, we're using WebEx today, but I'm sure everybody on this call has been on probably more than 100 Zoom calls. We were one of the largest holders of Zoom before the pandemic kicked in. I wouldn't say we were predicting a pandemic. We just thought cheap, high quality, easy to use video conferencing was going to be a powerful trend for the future, and Zoom was well positioned. We had also installed it in our own conference facilities and found it to be really as easy to use as I think we've all found it to be over the last couple of years. That stock went up 700% last year. And that was a pretty good analog for a number of other companies that were just well positioned for people who had gone home to work. And so whether it was healthcare or whether it was technology related, that kind of portfolio did really well during the pandemic. Between March of last year and September of last year, when we really saw those kinds of companies do extremely well, I will tell you that we did benefit strongly, but we also took a lot of chips off the table. After all, we knew that the state of mind in the pandemic's worst period wasn't going to be permanent. And we felt like we'd seen incredible appreciation in a lot of those growthy stocks. So beginning about a year ago, we started creating what we've called a barbell in the portfolio. We've continued to hold on to a lot of very interesting growthy names, but we began a year ago to add a lot of interesting names that we felt would benefit as the world's economy reopened. One that I'd mention, just because I'm sure everybody's heard it, but may not be quite as familiar with why we would want to own it in a growth portfolio, is Volkswagen. Well, Volkswagen happens to be the world's largest auto producer. Now in Asia, and you're over there pretty close to Korea and Japan, and you certainly are aware of the power of the big brands, Toyota and Hyundai and other large auto OEMs that are Asia focused, not to mention the Chinese auto manufacturers. It just so happens that Volkswagen is the largest in the world. And Volkswagen has made an enormous commitment to get in front of the change from internal combustion engine powered cars to battery electric vehicles. Most people think first and foremost of Tesla when they think of electric vehicles. There's a very good chance Volkswagen is going to sell as many electric vehicles this year as Tesla does. That's a fact you might not have been aware of. They're also spending $36 billion to bring their battery technology and all their car offerings that are electrically powered up to compete with Tesla. Tesla's been a great stock. It's a great company. It's a great brand. We don't think that Tesla will necessarily be able to keep all of their market share as the world goes from 6% battery electric vehicles to 50% and more in battery electric vehicles. And our suspicion is that Volkswagen is going to get a big piece of that. That's been an interesting play that's more cyclical, that's certainly much cheaper, that we've owned for the last year since we've thought about the world coming out of the pandemic. There are a number of other examples I could give you, but just to keep my answer somewhat brief, the point is we think that a balance between high growth stocks and some interesting cyclical recovery stocks is an appropriate mix to have in the portfolio these days.
Thank you, Chip. Very interesting take on Volkswagen. I'm sure not many of us were familiar with the underlying growth story there is to be had, or that may play out in the next decade or so, especially in the EV space. Now we have another question. This is addressed to Whitney. I guess the idea here is that there are so many funds out there. And I guess the question that some of our audience want to figure out is what is so special, or what makes Artisan uniquely positioned versus other asset management funds out there?
Well, I think there's a big thank you very much, Gino. I think there's two aspects to the answer to this question. One is how the firm is designed. We really want our talented investors, our talented portfolio managers, to operate in an environment that is distraction-free, where they can build their own network of researchers. Chip showed you the team page. We have 18 investment professionals on this team. All of those professionals are dedicated to these growth portfolios. There's commonality across them. The 4 portfolio managers that manage the 2 domestic and the 2 global strategies all sit in the same office. They meet every day, and they're very truth-seeking in their dialogue with the analysts and with themselves to make sure that they are exercising the best judgment in terms of determining what stocks go in the portfolio. So 2 aspects. So just to review, the firm's structure to allow these teams to operate independent of each other and not have a bureaucratic central research body. That all sounds great in terms of economies of scale and efficiency, but doesn't always give you the purest result. And the second thing is really the execution at the team level of this team that started with 2 or 3 individuals 25 years ago and has organically grown now to 18 investment professionals, plus people like Chip and other portfolio specialists that are 100% dedicated to getting the result for our clients.
Thank you, Whitney. Now we have another question. I think this is for Sir John in the local space this time. For Philippine investors, how does the World Equity Feeder Fund complement their investments? Why should they diversify outside the Philippine space?
Thanks for that, Gino. Thanks for that question. First of all, you've probably observed that the figure I gave you a while ago, if you started with us back in 2016, you would have seen your investments grow by over 80%. The same period of time, you would have seen a more volatile PSCI or a more volatile equities market. So having said that, I think it does pay to diversify. You find that in all of the strategies of all fund managers. So as an investor, you should also be able to look into diversifying your investments. First, of course, you know the Philippine market well. You probably own all of the companies that you want to own already at this point. So it's not time to move outside. I think Chip gave you already an idea how the fund will be invested. He mentioned some names that we're probably familiar with, some are not too familiar with, but the essence of diversification remains very much warranted as we invest along. So I think it has to be a complement of both. You're invested locally, but do not limit yourself, and you must always look for other opportunities offshore. And clearly, the opportunities offshore are just too massively wider than the ones here onshore. Thank you.
Thank you, John. Now I have another client question addressed to Chip. Especially, I think you mentioned earlier in your presentation, you'd want to cap cash at 5%. I would assume we expect upside given that cash is at a minimum level. However, with the rise of inflation being at its near high in the last few months, how will this affect the allocation of the fund? Maybe you can discuss, especially in the North America region, your holdings in that space.
Sure. I think there is no topic more on investors' minds globally than rising inflation. I would say certainly holding cash in a rising inflation environment is not a great investment strategy. And so I can assure you that there's nothing about a rising inflation scenario that would make us want to raise cash in the fund. Really, for us, cash is simply there as a buffer in case we have a great buying opportunity, or it represents sometimes a little bit of a transitory holding simply as we might be trimming a large position and thinking prudently about how to reallocate it. But we're not trying to hold cash to make a market timing call. You know, there are different companies out there whose business models are either going to be more inflation resilient or not. And I would say that generally speaking, growth businesses with differentiated products can raise their prices to offset the inputs of their costs. And we're seeing that in general across the portfolio. There are some examples of companies, and we most recently sold our position in Starbucks, principally because we were fearful of what rising inflation means for that company's margins. If you think about it, a large part of Starbucks' cost structure is their employees who work behind the counters, the baristas. You know, 3 years ago, Starbucks was paying their baristas an average about $11.50 an hour. I can tell you in the San Francisco Bay Area, they're paying about $18 an hour with a $1,000 signing bonus right now. That's great if you're working at Starbucks. And by the way, with inflation going on, you probably need the extra hourly income. But it's not so easy for Starbucks to raise the price of their coffee products as much as their cost of labor has gone up. And so in evaluating what that might mean for Starbucks' profit cycle, we decided to exit the position. That's a little bit of a standout. And I would say as we've looked across the portfolio, we definitely would observe that there are some supply chain disruptions for almost all businesses, whether it's a slowdown getting computer chips for Volkswagen and others, or whether it's delays in receiving steel for manufacturing. But we do think that those are probably more cyclical, and that over the course of the next 12 months, those kinds of inflationary pressures will probably relax. Labor inflation is probably stickier. After all, you can't really hire a barista for $18 and then tell them next year, now that the employment emergency is over, we're going to take you back to $12. You can't keep your employees if you do that. So for those businesses where labor cost is a much bigger piece of their operating model, then inflation is going to be stickier. I would say, generally speaking, across the portfolio, we feel pretty good about the capacity for our businesses to raise prices to offset inflationary input costs.
Thanks for that, Chip. I have another client question directed to you. I hope you're not getting overwhelmed with the amount of questions that are going your way. But the question here is, how does your portfolio compare to major US indices? I think this is in terms of active risk. I know you mentioned that it's largely a mid-cap. Your holdings are in the mid-cap space, but maybe you can discuss it in more detail with us.
Sure. Well, we're not trying to look like the index. I think we need to offer you a portfolio that can add significant value over what you can get in owning an index, or why bother? And I think history fortunately shows that we've been able to do that. Certainly what the history would show is that you're not taking extraordinary risk for volatility, if you'd like to define risk as volatility, in investing in this strategy. In fact, there may be a slide in the presentation that shows that. I've certainly referred to one with some frequency that shows that we've tended to preserve capital, and in other words, not go down as much as the index does in the course of bear markets, although we've added value in bull markets. And so I think we get those characteristics from owning high quality businesses. And for that reason, I'd say we feel pretty good about the performance and risk profile of this strategy. But I would say that we're not trying to look like the index. And after all, in a portfolio that's only 45 stocks with 60 to 70% of the capital in 20 of the stocks against a broad global benchmark like MSCI Equity with 2,300 stocks, we're not going to be able to look a whole lot like that benchmark.
Great input. Great input there. Yeah. Oh, why not just go to the tracker then, right? At least you can add a little bit value for our clients by sticking to your convictions. And I think that has panned out the last few years. Now, I have a question, or probably two questions for Whitney. I think we mentioned inflation, but are there other catalysts we're a little bit cautious or what we're watching out for in the short to medium term? And what is your view in the global markets and how it will progress in 2022?
Those are big questions. Clearly, inflation rising is synonymous with interest rates going up. So I think we're very conscious of the fact that certain companies benefit from a rise in interest rates, and certain companies don't. Will have a headwind from that. So we really just want to stick to what we do, which is identifying companies that are in the early stage of their profit cycle outlook. Just remind me again, Gino, the second part of your question, was it what the outlook for the global economy, was it?
Yeah, in 2022, is it a recovery phase? Is it some sort of correction, or just probably your own insights?
Well, you're welcome to get my insights. That and $4 will get you a nice cup of coffee. Artisan is the point of not having a chief investment officer that makes big grand calls about economy growing or economy declining. We're a decentralized firm, so we don't have a chief economist, a fortune teller per se, that gives you a forecast on the global economy. I think it's pretty clear that economic growth is going to be very, very strong over the next year or two. There's just been so much government stimulus from all the major governments to keep people employed and to get through the pandemic. That combined with very low interest rates by historic standards, I think I can say with some confidence that growth will continue, macro growth, top line economic growth will continue to accelerate well beyond long-term averages. And the real trick now is to really identify companies that we think will have that dominant market share and perform well. So everyone looks at the macro. Everyone has to be, you have to have an eye on what's happening with the global economy, with COVID. Every day, the growth team has a quick update on healthcare in the general sense around COVID and the recovery. We're very in touch with that. But what has enabled the team to generate excess returns is not so much their big call on the economy, but more what companies are going to continue to outpace the index and outpace their competitors. So this team would spend the vast majority of their time focused on just identifying the best 40 or 45 companies around the world that will outperform. And we stick to what we know best, which is really the areas around innovation and change within companies that can transform the underlying profitability. So I think it's an 80% micro answer and about a 20% macro answer. I hope that satisfies you.
Loud and clear, Whitney. I would tend to agree with you there, actually. Now we have another question, this time addressed to John. There is also, I guess the Philippines is one of the lagging economies in terms of reopening. Now, is it wise to also, I think you already mentioned that we should diversify, but we should still keep a portion of our investments in the Philippine space. John, would you clarify on that?
Yes, as I said, part of investing really is knowing where you're investing in. And we are familiar with our territory, of course. But as I said, we should not be closing our eyes on opportunities offshore. That's why we have partners like Artisan. But going to maybe how we view the Philippines moving forward. You're right there. We are probably one of the last ones, or we're probably the slowest ones to recover from the pandemic, but we will be recovering from that. So we don't want to miss that recovery as well. So we want to make sure that we get into the right names when we invest in that recovery theme. So yes, so no, be present here, and then have also a piece of your investment offshore.
Another follow-up question to that. I might be putting you on the spot here, but if you were to put a hard number in terms of allocation between the Philippine space and the low and the offshore markets, how would you divide that?
All right. It really depends on where you are right now. I think we would always do things on a phase. I think if you're ready for more volatility, then you can actually increase your exposure into other assets. But if I were to put a hard number right now, I would say it should be anywhere between a 50-50 mix of onshore and offshore. Uh, uh, my premise for being more bullish on onshore is the fact that yes, I think we are in the cusp of another inflection point in the market. Of course, we are heading towards elections next year, but more than that, I think the economy really is poised to rebound quite strongly after that. But so right now, I'm looking at towards that number. So that may change, like maybe minus 10%, minus 5%. So there you go. Don't forget also when you invest offshore, you also have the benefit of the currency, which was like what I've shown you at the start, gave you quite a decent bump in as far as earnings, as far as returns concerned. So don't forget that also.
Thank you, John. We have one last question. I'll be fielding this to Chip. It's a client-directed question. How does the fund navigate through bull and bear markets, and how does it transition from one to the other?
It's really hard to anticipate the market's direction. I think there perhaps are a handful of people out there who are famous in the world because they've called corrections in advance or they've called big bull market runs in advance. And I wouldn't put us in that camp. I think our view has been, if you go back and look at global opportunities for the 15 years we've had it, we launched global opportunities in 2007, and a year and a half later we had the global financial crisis and markets were down a very significant amount. And then we've made our way through what's been mostly a bull market period through the last decade, but with some sharp corrections. And the COVID pandemic in February and March of 2020 was another sharp downdraft. We didn't do anything differently at any given point in time to try and anticipate that the market had been going up for too long or that the market was now going down and it was perhaps time to reverse direction. And I think most people would tell you it's all about being in the market for the long run. And it's really what kinds of companies you choose to invest in. We took advantage of both the global financial crisis and the pandemic sell-offs to buy aggressively in the markets. And I'll just point out that in 2008, in the fourth quarter, when you may remember, it was a dark time. Lehman Brothers was allowed to fail here in the United States. The market went down something like 30% consecutively in 2 quarters in a row. We bought Apple, Google, eBay, Starbucks, and Amazon at prices you would love to have bought those companies at. And when the world didn't end, those stocks powered performance for 3 or 4 years following that. We aggressively spent down our cash in February and March of last year because we didn't think the world would end due to COVID. We got to a very low cash position. And as I mentioned, we had some pretty big holdings in names like Zoom and some other healthcare names like Lonza and Microsoft and others. And when the world didn't end, the portfolio probably appreciated 60% between March of last year and September of last year. So there are going to be tough periods in the market. And I will tell you, we don't have any great answers on how to predict those in advance, but our experience has been buy when the market's selling and then pay attention to valuation throughout most of the cycle, and you can make a lot of money in stocks.
Chip, I just jump in there. That's a great answer. I would say that when we look to identify with a partner such as Metrobank, we really want to have sophisticated clients and long-term clients, because one can never predict when an outperformance will happen, whether it's a bear market or a bull market. And it's the relative value that matters just as much as the actual market itself. And it's very important for us, for our clients, to be sophisticated and long-term and partner with us in the big picture.
Thank you again for the wonderful words that you've shared today. Now, I hope to the audience we were able to cover all your questions, if not most. Before we wrap up, we'd like to ask our partners in Artisan if they have any final words for the audience. Maybe we can keep a short remark or spiel from you guys.
Well, I think there's always the important topic that's on everybody's mind that can tend to influence investment decisions. And I think we've already hit on it. We've had a wonderful market environment for the last few years in general. And now there's a fear that inflation is going to be a real presence that could be difficult. I think investments all have to compete with one another for investor dollars. I think a rising inflation environment is really bad for cash. Rising inflation, if it means rising rates, is bad for bonds. And so I think it leaves you in a lot of cases with an opportunity to invest in stocks where those companies can pass inflation through by raising the prices of their products at the end of the day. And we feel pretty comfortable about that. And so you can never tell when it's a great time to start an investment or not. There's almost never a perfect time when it's very obvious. But I can tell you that we feel pretty constructive about the marketplace right now and the portfolio. And so we'll be interested to see what happens in 2022, but there's plenty of opportunities out there. They may not look like today's opportunities, but there will be plenty of good opportunities next year.
Thank you once again to our Artisan partners, managing directors, Chip and Whitney, and also to John for the panel discussion. We appreciate you guys being with us today and sharing with us those incredible insights and ideas. I'm sure everyone has learned something new from our discussion. I could say I personally have. Of course, we'd also like to thank our attendees who joined their session this morning and for their active participation. Thank you also to those who have submitted their questions. This event would not have been possible without you guys, and we are eternally grateful. Now, before we end this session, we would appreciate if you could spend a minute or two of your time to answer our short survey. We'll be flashing the QR code on the screen. Kindly just scan the QR code and access the survey. We'll also be posting the link in the chat box. Your feedback would be of immense help as we continue to improve our webinar series. That concludes our program. On behalf of the Trust Banking Group, I would like to thank everyone again for their participation in this exclusive webinar. Again, I am Gino Guevara. Thank you, everyone, and stay safe. I hope to see you guys soon. Thank you.